Good Friday morning, Market Chameleons. Thanks for joining the Market Chameleon pre-market show with myself, Will McBride, and the main man, all the way from somewhere south of me along the Delaware, Dimitri Pargamonic. How you doing, D?
Hey, Will, how's it going?
Good. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor or call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent. So what are you seeing this morning?
Here we go. Let me share my screen. So I think what we'll do today, we'll go over the pre-market report. And I had a question a couple of days ago. Customers saw unusual volume in PayPal. It was deep into money puts, and asked me about it. So it's something, I haven't seen in a long time. There's a reason for it, because we have been in a 0% interest rate environment.
It's got something to do with interest rates.
Yep. So what I'll do today is I'll go to the PayPal, go back, show you guys these put transactions and explain to you what I think is happening, how I interpret it, that particular trade.
And maybe we can talk a little bit about Yahoo, discussing that as well.
Yahoo?
I don't know if you remember Yahoo back in the day, but I just occurred to me what it is.
Yep.
Yeah.
Yep.
All right, cool.
So we'll know. So before we get to that, let's take a look at the pre-market report. And these are stocks trading in the pre-market hours. And we got the most active stocks, biggest percentage gainers, biggest percentage decliners. Here I see 66 stocks made our percentage gainers list, 48 on the percentage decliners. So from that perspective, we're looking like we're setting up for more bullish bias at the open. I'm going to filter out this list to just S&P 500 stocks to see what's going on there. That will take out any small cap stocks, ETFs, leverage products, preferreds, all those we're going to filter out just to focus on S&P 500 stocks. So to do that, I'm going to use these filters above, and using this filter in ETF, I'm going to drop it down. I could select any of these ETFs. I'm selecting SPY, which is the S&P 500 ETF. And now this list got filtered out by holdings in SPY, which are the S&P 500 constituents. So we see 18 stocks here made our percentage gainers list, 3 on our percentage decliners. So that, again, looks like we're setting up for more bullish bias at the open. I see top of the list, Citigroup reported. They just reported earnings. So I think that's what this is reacting to. An earnings report, a couple banks, right? UNH just reported earnings. That's reacting. So I'll take a look what Citigroup said. I didn't have a chance to read their reports yet. It's early in the morning. I was looking at other stuff, but I know that they've been trading at a pretty significant discount to their book value. I believe like they're trading at half their book value, which, for banks, they're usually, I guess, it's hard to put a value on banks because, they carry all these risks, but usually you're looking, people look at when they're trading below book value, it's a buy, above book value, it's a sell. So they're trading at let me just check real quickly.
Well, it is interesting too, because JP Morgan reported yesterday, right? And Morgan Stanley. Yeah. And
so you can see they're down 3% yesterday, but here you go, book value, they're just to compare it to say like JP Morgan, they're trading at 1.3 times book value. So look, it's hard. I've tried to go in there and look at their assets, and it's so confusing. You don't know how to price these things. I think even Warren Buffett has trouble, and he's in that industry, but banks are pretty hard to price. But I think the simple rule of thumb is, when they're significantly above book value, you got to be cautious. Once they get below, maybe start taking a look there. But again, it's if you open up those filings and start looking at it and trying to figure out adding it up to get to book value, it'll be very difficult because they book profits, but they carry long-term risk, right? And you got to try to figure that out. Having said that, I think there are a couple numbers today that came out, retail sales and so forth, but still we've got headline news, still inflation, and we've been talking about also just the SPY, earnings yield. Before I get to that PayPal, a couple of things that I did also just kind of want to show you guys relative to, we were talking about the earnings yield in SPY relative to cost of capital going up. So we've got like around right now 4.9% earnings yield, trailing 12 months. I think interest rates are going to 3%. That's what the indication is by the end of the year. So that's really narrow between that earnings yield and the cost of capital. And when you're looking at that yield isn't that great. If you think, we're at 3% on the 10-year, probably going 3% on the Fed funds. So that spread to me seems very narrow, even the EBITDA yield. So the only way this would make sense is if we see maybe explosive growth in earnings, right? So these are trailing 12 months, but if earnings are going to grow fast, and we could see here, 3-year, 5-year compounded annual growth rate, 14, almost 15% per year, which probably then could justify it potentially. But what I think a lot of that earnings growth, this is my opinion, but I think a lot of that earnings growth was generated from an explosion of money supply. So, we were able to keep interest rates low because there was a lot of productivity and a lot of deflationary pressures coming from the internet, I think mobile devices, and globalization. And now we're seeing, I think, at least one of them, the globalization part of it, that's slowed down dramatically. I think we're not seeing the benefits like we used to, especially like if you look at China, and if you read reports, China is always mentioned in S&P 500 stocks. I always see China. So I think their GDP right now is also at one of the lowest growth rate. They're not growing at 8% anymore, right? Or 9%, whatever it was. I think they don't even know if they're going to hit 4% this year. So that's really slowing down. I think we've got all the benefits out of that. It might be flatlining. And also from the internet and mobile devices, it's starting to slow down. So I think those productivities we've already benefited from. So why is this, so what's going to drive this? And I think another part that's been driving earnings growth is this. It's the money supply. So you could see here, this is our money supply. And as you increase the supply of money into the economy, really your earnings and the stock market might mirror this, right? You're just pushing money out, lower interest rates, more money available, driving inflation because we don't have those productivity gains. And especially from here to here, right? Like from here to here, that was a huge jump. Here, I'm going to expand it just to show you the max. So you see how the money supply has been just increasing at a accelerated rate. You can't do that forever, especially if you don't have an explosion in productivity, right? So, or, population or whatever, so this has to level off, maybe even come down depending where inflation is. And I think that is also going to weigh in on the growth in earnings, because I think what about 20% of our GDP is coming directly from from the financial sector, real estate, banks, financing, stock. So that is going to get impacted pretty hard. Also, as if the economy slows that down, contracts, there's going to be less revenue coming in to the government, tax revenue, and the cost of borrowing. Our government borrows money, right? They spend it. The cost of borrowing money is going up. So that's less government spending. So about a third of our economy, I think, is going to feel it like pretty quickly, right? And that's why I don't think that right now, if you look at projections, the projections are basically like they're looking at those historicals and projecting, 10% growth year over year in earnings. And I think that part of it, might, we might be surprised there. So just wanted to point those out. PayPal, let's go. If there are no questions, I'll go to PayPal.
Yep.
So I had this question over here. I'm going to go to options chain. And I believe, let me see, when was it was these January 23rd. So in PayPal, in January 2023 expiration, you got a bunch of in the money puts trading. So you see, this is the 280 put. So the stock is $70, right? So you could see here, the 280 put 3,400 traded, 270 put 1,000 contracts, 260 put or whatever this is, 250, 3,000. So you could see big volume deep in the money puts, really deep in the money puts. So what gives? Why is somebody doing this, right? And we haven't seen this in a long time, and it has to do, it's not a directional bet, okay? It's, in my opinion, it's more of a cost of carry bet. So before I show you why he didn't, and it has to do also with open interest. So let me just open this up. So when you're looking at a very deep in the money put, right? Look like this, like say the 280 put. This put itself has a 1 delta, meaning that you see here 1 delta, meaning that this put, 280 put, will move 1 for 1 with the stock for every dollar move right now. As long as the stock's around here, it's going to move 1 for 1. So according to the option pricing model, if the stock moves down $1, this put will move up $1, right? Because it's a put, it's in the opposite direction. If the stock moves up $1, the option will move down $1, right? So, but it's moving in a 1 for 1 ratio, right? So it's behaving kind of like just like the stock. So if you sell it, it's kind of like you're long the stock, right? And so what would happen? So what position would you want on this, right? If you could, instead of buying the stock, right? Instead of buying the stock, you could sell this put, right? So let's say you sold this put for parity. What do you think is better, theoretically? Is it selling this put and bringing money in, right? So you're bringing in whatever this was, 209 or whatever it was, 208, or buying this stock for $70, right? So if you had those two choices, and you said, well, if you think theoretically it's basically the same thing, well, isn't it better to have $209 sitting in your bank account earning interest, Or is it better to take $70 out of your bank account and own the stock? So basically, what you're doing is saying, okay, I'm selling this put and collecting interest. So because interest rates are going up and you're carrying this for 132 days, right? That means you're collecting interest on that money. Now you could hedge it, right? So you might not even want the delta. You may not even care that on the direction PayPal is going up or down. So what you would do is sell the put and sell the stock 1 for 1. That's your hedge, right? So if the stock goes down $1, you lose $1 in the put, but you make it back on your short in the stock. If the stock goes up $1, you lose $1 on your hedge, but you make it up in the put. So you're hedged up and down the whole time. You don't have a directional risk. Every day you're earning interest until expiration. So why can't you just do it everywhere, right? Well, you can't do it everywhere because there's an early exercise. That means that if you sold the put to somebody and the other side knows this and said, well, I don't want to carry this put and pay all this interest, I could just short the stock, right? And collect interest. There's an early exercise, and if they exercise that put, that means you no longer have that position on. So the position only works if you could carry it for a lot of days earning interest, right? So you don't earn interest, you don't earn all that interest in one day. It takes time. So think of it this way: if interest rates are 2% and you have $200 in the bank, in a year that's $4, right? That's how much you would earn, $4 on this. So in a half a year, let's say approximately $2, quarter of a year. So you could see that it will take time, but your interest will accumulate. The problem is that the other side can exercise that put. So what are these market makers? These are market makers doing. So what are these market makers looking for? Is somebody is forgetting to exercise the put. So you see all this open interest? This open interest is indicating somebody out there is holding these puts in inventory, is not paying attention,
or they don't want to exercise them, right?
Or they don't want to exercise them, meaning that open interest is gonna, their speculation is that it's gonna remain that way, and the other side is not going to exercise the put, and you will be able to hold that position and earn interest up to expiration, right? So, but how do you get?
That people forgetting about it or not doing it right gets back to when I mentioned Yahoo, and there was
big.
I mean, remember a newly minted multi-millionaire owned a ton of puts in Yahoo. Well, that was the story actually on the floor. He owned the puts in Yahoo because he had a lot of Yahoo stock. He couldn't sell the stock, so he had, either was advised or did it himself, bought the puts, right? Remember that?
Yeah.
And they were deep in the money because Yahoo had been like I don't know. I think you traded Yahoo, didn't? How high did the stock get? It was.
It was like, in the hundreds, and then went down to like $20.
Yeah. So it was like a $25 stock. These puts were at a strike price somewhere in the hundreds. Yeah. And it turns out it was Mark Cuban, right? He had sold his company to Yahoo.
Oh, you're right.
That was
they might story. Have to hold those put, right? They can't exercise it because once you exercise, in effect, you sold the stock, right? Once you exercise the puts, you basically sold the stock, and they may be restricted or whatever. I don't know, right? Or they forgot. But the point that the market makers are looking at is somebody out there is not exercising them, which creates an opportunity, a cost of carry opportunity, right? So you could hedge these puts. You don't have to carry directional risk. And every day that this position somebody doesn't exercise it, you're earning interest daily, right? So if you're a market maker or whatever, you could get the risk-free rate or a little bit lower. Let's just call it 2%, right? 2% on $208 is a significant amount, right? So the deeper in the money they are, the better, right? Because even these are even better, right? Because these, you're bringing in more money, and that money is just sitting in your brokerage account, theoretically earning interest, right? So what do you do though? Because you were not the original person that sold these puts, right? So you don't have that position on, somebody else does, right? So somebody else out there is long, somebody else out there is short, but you're the market maker. And as a market maker, you understand. Now, don't go out doing this. You'd have to have these market. You'd have to be a market maker.
Yeah, this isn't a trade.
This is not a retail, right? This is only explaining to you what the volume is and what's, so you don't misinterpret, because some
the market makers can do this a significant number of times, and their costs are very limited. And they do it as a spread, right? And so the ones who are exercising are actually market makers. That's typically how they do it. Correct?
Market makers are trading it between themselves, and what's happening is that they're trading it back and forth between themselves, taking turns exercising. And the way the OCC does it, Options Clearing Corporation, is when they assign it, they don't. It's not first based in first in, first out, or last in, first out. It's all random. So the more they do it, they're siphoning it off. And so the person, what's happening is the original person shorted is getting assigned by the market makers, and the market makers on the other side are getting that short. So basically, those market makers will end up, after doing this, they're going to end up short the put, short stock, and earning interest. So that's the play. And I say this because, we look at order flow, we look at what's going on, and it's important to understand it, because I think when I was first, and I haven't seen this in a while, the reason is the market, we've always been in a bull market, so for a while, so a lot of this, we didn't see deep into money puts like this in a long time, and interest rates were low, right? So all this has to fit for this type of trade to work. So you'll be able to see that the open, even though you're going to see a bunch of these, all these are going to get exercised. So the open interest probably is not changing. But what's happening is that slowly what they're doing is trying to take over that short side of the trade that exists in the open interest.
Perfect. That was awesome.
And I think that when I was contacted, the person was really looking at it from a directional bet. Like, so he's like, well, somebody.
Yeah, well, you see all these deep in the money puts trade, you think someone may know something, right?
Yeah, and I actually don't have it in our order sentiment. I have to change our algorithm to detect it, because it didn't happen for so long that I don't think I included this type of trade in our algorithm.
Yeah, the telltale sign though is, if you looked at the trades, I'm sure they're all going up as mid-market, right?
Yeah, like mid-market,
and they're a lot of spreads.
Yeah, and you can see there are a lot of spreads. They have to do it a lot of times, back and forth between each other, either through vertical spreads or back and forth, where the other side, both sides know what they're doing. Both sides, it's a prearranged trade that probably is it's just.
Well, we debated this internally ourselves years ago, right? We debated whether we wanted to participate in these things because we thought there was regulatory risk.
Yeah, because they've been, I guess the way they look at it is, if the exchanges allow it to do it, the exchanges are, regulatory, then you're left. But it is debatable if it should even be allowed to happen. Probably if you enforce the rules the way it should be, you wouldn't see this, right? Because it's a prearranged trade. It's really like a wash trade based on uh the knowing how open interest rate and exercise assignments work.
Well, the other thing is, I mean, you're supposed to have these advantages because you're actually making markets, right? And what we witnessed when we were involved on the floor and even off, because we knew people right? They're market makers in name only. They're not making markets probably in this product. What they're doing is participating in this, whether it's an arbitrage or a spread. It's a strategy. The strategy only works if you have the market maker margin, and to have that market maker margin, you should be doing market maker activities. That's how the rule reads.
Well, the rule reads, if you have a privilege, it should be to provide some service, liquidity, or whatever. This isn't it. So it's very debatable. I mean, I'm not sure why somebody at the SEC honestly just at one day are going to turn around and be like, no,
Yeah, because listen, you're doing a great job letting people know why, but I guarantee you there are people out there who look at this as, thinking that it is something to do with the stock, right? That
it's like the tape, right? It's like, but yeah, no, for sure. But we know the same thing with the dividend spread. The dividend spread, it's been going on for a long time. Eventually, and I think that it's confused because somebody has to understand it. And I do think that there are probably a lot of people who work for the SEC do understand it. They're very smart, and it'll get shut down. Maybe even you'll see potentially fines. But that's what it is. This is basically taking you have to have certain privileges to be able to do this trade.
Very cool. Well, thanks for explaining that, my friend. Awesome job. It is now 2 minutes before the opening. Any last words for the chameleons? Are you ready to?
No. Yeah. I think that's it for today. Everybody stay safe out there. Have a great trading day. We hope to see you guys on Monday.
All right. Have a great weekend, everyone, and a great trading.